Good afternoon, everyone. We're going to wait just a moment as people trickle in. Hope everyone's enjoying their summer and getting time with family and friends. All right, let's kick things off. I'd like to welcome you back to 3 questions, 20 minutes, one guest, sponsored by Lucern Capital Partners. Today, we're going to focus on small bay industrial, and I'm joined by my business partner, Frank Forte, who also serves as our Chief Investment Officer at Lucern Capital. Always enjoy having him on, always shares some great knowledge and information. I expect nonetheless nothing but that again today. So Frank, if you don't mind, just share a little bit of background about yourself, and then we'll dive into our questions.
Yeah, sure. Well, thank you for having me. I am Frank Forte, as David mentioned, the Chief Investment Officer and partner here at Lucern Capital Partners. We've been here for about 8 years, investing in a wide variety of asset classes up and down the East Coast. And my role here, as David mentioned, is to source, identify, underwrite, and ultimately close on investment opportunities that meet the needs of our investors, both on a yield, cash flow, and IRR reversion basis. So I'm happy to be here today and discuss some of the merits of our newest darling asset class, small bay industrial real estate.
Perfect. Thanks, Frank.
Sure.
So touching on small bay industrial, can you kind of tell everybody what exactly it is and how it's differentiated from industrial as a whole that most people think of?
Yeah, sure. It's a great first question. So most industrial is what you see on the highway, right? You're driving and you see a really big distribution facility, right? A lot of dock doors and a lot of trailers lined up, and it's a Walmart is occupying it, right? Or Amazon or TUI.com or Jet.com, one of these big companies. So that's one type of industrial, and that's called logistics and distribution, right? Some people call it 3PL for third party logistics, and then and that's usually when another company handles it on behalf of other people, but same type of building nonetheless. Then there are manufacturing buildings, which you may, anywhere that anyone's lived, there's always that industrial piece of town, right, where there's it's a little grittier and there's some buildings, and maybe you have some random companies in there doing X, Y, and Z, and we manufacture sealed air containers, we make bearings for wheels or whatever it may be. And those are single tenant industrial buildings generally, and they're a specific use, right? People use them for to create things and manufacture, or maybe it's research and development. And then there are business parks, and everyone here has seen one, right? And a business park is, you're driving that proverbial industrial section of town, and you pass by and you see a sign, and there's 5, 10, whatever, 12 names on it. And there's a bunch of buildings that go with a bunch of roll-up doors, and it's a patchwork of businesses in one of these industrial parks. That's what small bay industrial is. So it's usually suites that range in size, and usually they're below 10,000 square feet. And true small bay is really 2,000 or 3,000 square foot suites and below. And really, what it does is it caters to your service people, your tradespeople, small businesses, HVAC, plumbers, small distribution guys that do landscaping. You have guys that distribute tile. You could have, we have a moving company in one of ours. You can have people that, we have one person that rents a lot of short-term rentals, and they use the space to commercially launder all of the bedding and all of the linens from all these rentals, right? So it's literally a universal tenant base in these smaller suites that needs a place to hang their hat and to do whatever they do for their business. And sometimes, not always, but sometimes there's a very small office in the front, and it usually comprises 5 to 10% of the space, and it's just a little place where someone's sitting with a desk and a computer. Less to greet customers, more to just take care of business, right? Maybe it's your coordinator, or it's your accountant or a bookkeeper, or someone's taking inventory. So that's what small bay industrial is. It's smaller suites that cater to a wide variety of uses, And the most important thing I think about it is the least specialized out of that stuff that I just mentioned. So for logistics, you have these 100, 200 million square foot buildings. They need to have a certain amount of dock positions. They need to have a certain amount of cubic volume, and that's dictated by pallet position, stacking height, and overall, the decking, sprinkler systems. It's very technical what some people will do, because when someone's renting a space, they're renting it and they want to maximize it, right? If they're a logistics operator. With small bay, people aren't looking to maximize their space. It's someone saying, hey, I have a small business. I don't have anywhere to go. All of the office space is too expensive and it doesn't cater to my needs for storage or maybe some grittier equipment. And I need a place where it's close to my local community, right? The folks that run small bay are not going to be people that are driving 100 miles away to service clients. They're people in the community. So it's very regional and local based businesses that service the community. So the most important thing, like I said, is that it is the least specialized, which means it caters to a wide variety of users, which means you get diversity, and it means that the downtime for these suites is also less, because the ability to fill them is very easy because of the lack of specialization.
Cool. That was very informative. Thanks on that. So let me ask you, when, and more importantly, why did you start focusing on this asset class?
Yeah. So, we started focusing on the asset class for a couple of reasons. One, multifamily was getting very top heavy, as we all know, and we were looking for other opportunities. We had an opportunity to build a small bay industrial property during COVID through sort of a odd coincidence of events. And we're not developers by trade, as everyone here who follows us probably knows, but we had an opportunity to build it. We were super successful with it. And in general, it's really, really, really difficult to build small bay because you can't find the land. It's atrociously expensive to build it. And we had a couple special circumstances that let us build the building. But nevertheless, we realized, hey, this is really interesting. And much like multifamily, you have this diversity of tenant, right? And the tenants are on shorter term leases. So a big 3PL building, like we talked about, or a logistics building, those guys are on 10, 15, 20-year leases. So once you lock in a lease rate, you might get 3-4% steps. And it's like a bond, right? It's very predictable. You know what it's going to pay. With small bay, the tenants don't ink leases like that. They tend to ink 1 to 3 year leases, maybe 5. So you have the ability to reprice and push these people to market sooner. So it acts as a better hedge against inflation. So that's reason one we started looking at it. Reason two is the diversity of cash flow and the relative similarity to multifamily. And I'll touch on some other stuff where it's not similar. The relative similarity to multifamily in the sense that it's multi-tenanted. A lot of hardcore dyed-in-the-wool industrial people will stay away from small bay because they think it's management intensive or it's a headache compared to what they're used to as being a single tenant. And I see David laughing.
Walk in the park for a multifamily.
That's right. It's a walk in the park for a multifamily person that's used to managing 100, 200, 300 unit apartment building. The biggest multi-tenant property we have has 30 tenants. And that's pretty unusual, right? So you have that aspect of it. You have the inflation hedge. But more than that, we always try to look for plays that have some sort of, support and barrier to entry. And with small bay, like we discussed, you can't build it. You're more likely to build a big logistics facility. Hence why we're seeing the supply glut in that space right now, right? You're more likely to build that because you're going to drive costs down. You can't even find the land. Industrial land continues to get zoned out, especially the type of infill land that generally services these flex and small bay properties. And we call it flex, by the way, because it flexes between office and sort of industrial. And that's not something I mentioned earlier. So I wanted to make sure that was included. But, the natural transition to it made it very easy. We did spend a very considerable amount of time, over a year, going and researching even a market like Charlotte, right, that we've been in for 8 years. We know it so well, but we didn't know the industrial side of it, right? So we spent a year. David and I bought a property together without investor money to prove the thesis of doing this before putting investor money ahead of ours. And that property, we're doing really well. We're actually, we're killing it. And it took some time to figure out. But I think the most important takeaway is that it's not going to be for everyone. I think there's a lot of people that are out there that are feeling a little jaded, they're feeling a little beat up from multi, and they're looking for like that next thing. And you see some of these folks going into the storage space. There's some, admittedly, in the last 2 months, all of a sudden everyone's talking about flex industrial. Happy to say we've been doing it now for 2 years, but there's a lot of people that are all of a sudden rushing in because they think it's the next good thing. And I think what's important to understand is that it isn't for everyone. There's a lot of nuance that you have to understand with functionality of space, the type of tenants, the way things are done. That's not so straightforward, and it's not as easy as a multi-building where you say, all right, I have 30 tenants. We're gonna, turn 30% of the population every year for 3 years. We're gonna bump the rents by 200, and we're gonna put in our model a lower cap rate and send it and be on our way. It's not that simple. So I think a lot of people are going to struggle with that. There's going to be people who are going to overpay. And, for us, it's become really our sole focus. And we've delved in and we've turned up quite a bit of opportunities so far. And we have some more in the pipeline. So you got to really understand the space. And I fear, and I hope it's not the case, but I fear there's going to be a rush of people in, similar to multi, where everyone thought it was easy and it was the next thing. And there's going to be people who get burned. So do your diligence, understand what you're doing, and before you hop in.
In an interesting way, it's very similar to what we saw in multi back when we started about 8 years ago, where there's a lot of old ownership and there's a lot of opportunity for upside.
Right.
It's a much broader market as far as multi, but that kind of leads me into my last question. How and where are you finding these opportunities, and what kind of return profiles can you find on this type of investment?
Yeah. So it's very difficult. I'm actually really glad you brought that up. It's very difficult to find these opportunities. So multi is kind of funny, right? Because if you have a gigantic bucket of money, if someone gave you $100 million of equity, and you even said, "Hey, I'm going to lever it 2 to 1," and we obviously saw leverage much greater than that in the last few years. But let's say you said, "I'm going to lever it 2 to 1, 200 million." You could probably go out and spend that just in Charlotte, right? And maybe it wouldn't be the best deals, all of them. You buy some that you'd compromise on, some that were really good, whatever. But you could literally go buy, a portion of the market in Charlotte for that. It wouldn't be the whole market because there's so much multi, but you could deploy it all in one place and be happy and probably do pretty decent over a long period of time. With flex, there is significantly less of it. It is not being built. The stats were last year, and this didn't specifically refer to flex or small bay. It was just talking about the footprint of the building. But 1.5% of the product that was delivered last year in this country, in industrial, and the billions upon billions upon billions of square feet delivered, 1.5% of it were properties under 50,000 feet. So there's no deliveries of this stuff because you can't build it. You can't find it. The cost is prohibitive. The rents don't justify everything that you would think would make sense of why not to do a development. So you have to branch out to other markets. So naturally, we've started in our home, kind of base of Charlotte, right? Even though we're based here in New Jersey, Charlotte's near and dear to us. 8 years now, 7, 8 years, whatever it is. So we started there. We're now starting to look into other markets, and we've spent a lot of time, similar to Charlotte, understanding those markets. There's a market we've been on the property now. We won't spoil it for the crowd here. Maybe we win, maybe we don't, but we've spent the last 8, 9 months looking into this market. Finally bid. We'll see if we win, and it's going to be a new market for this asset for us. But really strong, has all the characteristics we look for. But again, you can't really. If someone gave me $100 million today to lever 2 to 1 in Charlotte, maybe even in North Carolina, probably be impossible to buy product just in North Carolina, maybe even just in Charlotte, maybe even just in North Carolina, probably be almost impossible. The deal sizes are smaller, they're more infill, there's many more of them, and they're harder to find. So you have to look outside, and it's a slower kind of uptake. And I think that's what's kept a lot of institutional players out of the space because, we all know it's just as much brain damage to do a 10, 20, $50 million deal as it is to do 5, right? So, if you're an institution, you have to put out capital. You're looking to get out into the market as quickly as possible with velocity, and you just can't do that here. So that's kind of, hopefully that answers your question.
Can you, just as the tail end of that question, any kind of bookends as far as what return profiles look like in the space?
Oh, sure. Yeah, I heard you ask that. I trailed off. So I would say the deals we're looking at are all upper teen IRR type deals. There are a lot of deals out there that are low to mid-teens, which is not what we look for. Those tend to be the newer construction deals that were built in the last 10 years. They're brick, they're super sexy, whatever. That stuff is not going to be the stuff that gets us excited and our investors excited. We're really aiming for that 16, 17, 18 and up return profile. So, just in the last month, we probably evaluated 30 or 40 deals, most of which were pretty crappy. And there's a couple of them we put offers in, and we'll see what happens with the economy, with the elections. Everyone is a little bit uncertain, and that's, once the certainty of interest rates and the election drops, I think the shoe on transactions falls and people start to do stuff in the market. No matter where interest rates are, the market will normalize. But that's kind of what we're looking for in the return profile. And like I said, only a few of those 30 or so have really met that, and then even so warranted an offer. So it's tough to find good product.
Great. Well, Frank, thanks as always. You always have valuable insight. If you want to connect with Frank or myself, you can check us out at lucerncapital.com and shoot us an email or message through the website. And we look forward to joining you guys next month with a new exciting topic. So thanks, Frank, and have a great day.
Thank you so much.
All right. Bye.